G'day everyone, welcome to the weekly general update for the 4th and 5th of August. And during the week that's just gone, we saw the central bankers in America and Europe strut their stuff, and it's becoming increasingly apparent that these guys are fighting a losing battle, and particularly in Europe there's a level of incompetence that is really just quite extreme. And then we saw the most amazing reversal on Friday night from a negative sell-off on Thursday that really just reeks of market manipulation because it just defies logic and it defies normal crowd behaviour. But we'll have a look at that in the charts in just a minute. Just a reminder, this is general advice only. So looking at a summary of the week, the S&P ended up gaining 5 points, but that was only because there was a huge reversal on Friday afternoon and Friday night. And it's interesting, 4 of the biggest moves in the last 5 weeks have all been on Friday, and that kind of adds weight to this suggestion that you know, there are people behind the scenes who are pulling the strings for Fridays to be consistently a huge up day, and they're all to the upside, by the way, is really quite interesting. I've not seen that before. Now the S&P index is back at key resistance again, but the strength of the move on Friday night, you'd really have to shift back again, and I know that we have to keep flip-flopping back from appearing to go down to appearing to go up, and it's pretty hard to pick very short-term market direction at the moment. Now the jobs data was a little better in the US, and that helped fuel a second leg to the rally. So markets took off on Friday afternoon out of Europe for no apparent reason other than they changed their mind. They sold off on Thursday, and correctly so, and then for no apparent reason just turned around and decided to go up. And then some better jobs data in America continued that on. But the whole thing to me just bears no resemblance to reality whatsoever, and I think any rally from here has got to be on shaky ground. I'd be very careful. Now the currency movements, again, as I said prior to the start of this week, the odds, I believe, were towards more upside because of the way that the euro had rebounded, and I think we're back in that mode again now. We'll have a look at the ASX 200 index. It ended up gaining just 12 points on the week, but it will obviously have a fairly strong move on Monday. And it's still just flirting around the top of a broadening trading range. Hasn't really been able to break out, but if the banks were to move up another level, then certainly that would occur. But outside of the index, you're looking at the vast majority of stocks, and there's really so many of them going sideways and so many of them going down that if you're just following the index, it's really giving you a very, very false idea of what's actually happening in the general market. Now the US dollar index, there was a failed breakout of the range, and then we got a very strong decline again on Friday night. So it very much looks like it's heading towards the bottom of the trading range at this point in time. And the euro probably targeting at least 126, but we'll look at those charts in just a minute. Now bond yields, Spanish bond yields, the 10-year were up and down and all over the place, but eventually finished just under the 7% level at 6.84. So let's have a look at those couple of charts, and we'll start with the US dollar index. So pan back, and you can see this range 81.50. We've been looking at this now for many weeks. 81.50 to 83.50. We got a minor break that turned out to be a false break about 2 weeks ago. We had a fairly definite retracement into the range, which is always a sign that it's probably going to the bottom of the range. We had an abrupt turnaround on Thursday when Mario Draghi had effectively nothing to offer, and then inexplicably it's just turned around again massively. So these last 2 days really, it's just not crowd behavior in the way that you would normally see it. This is market manipulation at a massive level. So I think we're probably looking at the US dollar index coming down and at least retesting 81.5. We may even get a false break to the downside on the US dollar index. But if you look at the euro, it was a very significant turnaround the previous Friday, and I said in last weekend's alerts that we could look for 126. So you can see panning back, this is a very clearly defined trend channel there. The price was sitting around about the middle of it. The strength of that reversal suggested we could go to at least 126. On Thursday night it didn't look like it was going to happen, but then of course last night or Friday night it turned around and zipped way back up again. So I think the odds are that the euro will head to 126. That means that the US dollar index will go down, and that will be good for stocks. So I think on balance we've probably got to stick with the upside just for the time being. But really, as I said earlier, I'm very wary of this rally. Now the other indicator that I want to take a look at as well, and this has been one that's been confusing me for quite a few months, and that's the VIX index. This is the VXO, and you can see we had two very sharp days down on Thursday and Friday, and even despite the stock sell-off, it was really weird that the VXO went down so sharply on Thursday night, and then of course continued on down, and we're now down under 15, and that's a level of complacency. You can see we're almost down to the lows. So there's absolutely no fear in the market whatsoever. So another reason why I just don't think there's going to be much downside in the market in the very short term. It's going to take some kind of trigger event for that to really happen. So let's have a look at the S&P index. Now if you leave aside last night, then we had, as you could see, we had a strong run up from the June lows. We then got a smaller run up to the July 3 high. We then got a smaller run up to the July 19th high, and again into the 30th of July high. We encountered this strong overhead resistance that also corresponded with this Fibonacci retracement level up here at 78.6. So it all came together. We got a reversal candle, a sell pivot, confirmation the next day, confirmation again the day after that. This was the most perfect setup that you could possibly imagine. We got the sell-off on Thursday night, and then just whammo, out of nowhere the market heads back up again. So it's just not normal patterns at all. Now the question is, we're tucked up under this resistance level now. Where to in the short term? As I said, looking at the currencies, I've really got to go with the upside, I think, in the short term. Once the euro gets to around 126, if that occurs, then I'll be interested to see where the where stocks are. If they're somewhere up around this 1422 area, that would form a double top, and that would be a great area for markets to start to break down. But look, it's just a day-by-day proposition at the moment. Now the other index I want to take a look at is the German DAX, and you can see here that it's also forming higher highs. It's really a broadening triangle on this index as well, so the next couple of days are important on the German DAX as well. Now our market is also tracing out a broadening triangle as well. As you can see, we got a minor break of that triangle on Tuesday of the week just gone. We had a sharp reversal on Friday, which is what you'd expect, but I would imagine we're going to be up around these highs again on Monday. So I think where the index goes, I really don't see a lot of upside for the mining sector, because BHP has just announced some major asset write-downs. Rio's travelling a little bit worse, so I really don't see much consistent, sustained support coming in for the miners. So I think it really is up to whether overseas money wants to continue pouring into our banks for the yield. If that's the case, then I guess 4,400, 4,500 is possible on our index. The other chart of interest is the Shanghai index, and it's really going in the opposite direction to everything else, as it often does. You can see we've got a downsloping support line here, which the price is getting close to, but you've got to say that the Shanghai index over the last couple of months has been going very contrary to the rest of the global indices, and that's despite the stimulus that they're bringing in now. Now let's go back to the summary. We'll have a look at gold. Gold dropped $20 on the week, and it's the 13th week spent in the trading range between 1550 and 1650. So if you're getting a bit frustrated by gold's lack of action, then you know that's why. 13 weeks effectively doing very little. The Huey index finished a few points lower for the week, but when we have a look at the chart, it's still showing some promising signs, and I'm still of the view that we're not that far away from perhaps a sustained move in gold stocks. Now the global gold ETF, the biggest gold ETF, is GLD, and that's broke out above the trend line, is holding the break, but it just needs to get up a little bit higher to confirm a renewed uptrend. Copper ended up steady, $3.37 on the week, so not a lot of change there. And that's the other interesting thing with those massive moves on Friday, that we didn't really see a response from commodities. Even though the US dollar fell significantly, commodities really didn't move up. And again, that just to me lends weight to this market manipulation theory, because you really would have expected commodities to move up if it was natural market forces. Oil was volatile over the week, fluctuated over about a $6 or $7 range, but finished at 91. This is the 6-month chart for spot copper, so you can see it's really been in a similar kind of trading range to what gold has. So let's have a look at those couple of charts. So first of all, we'll look at US dollar gold. That's in on a weekly chart, 13th week in this very tight little band, and it's going to break one way or the other, that's for sure. And when it does, it'll move significantly. Just looking at it on the daily chart, you can see we had a tightening wedge here. We broke clear of it earlier in the week, and we've come back and retested that breakout on Thursday. Silver, by comparison, also in a big sideways move, and has really been locked in this range now between 26.50 and about 29.50, and that's been the case now since about the middle of May, so quite a lengthy period of time. Let's have a look at the gold ETF. You can see we've got this very clear downsloping trend line. We broke above it on the 25th of July. We've come back, we've retested it, which is normal market behavior. Hopefully we can hold and push higher from here, and really I'd like to see a move above 159. If we can close above 159, that to me will confirm the break and the start of an uptrend in gold. And the final chart I want to have a look at is the HUI index. And again, you can see we just had a minor break of this resistance line. It's come back into the trading range, but not with any great definition, and has just poked its head back above it on Friday night. So the gold stock's just hanging on to that break for the time being. So finally, just wrapping up, the most likely scenario for me is that central bank action has really scuttled what you would normally expect to see in the market patterns in the short term. So that means that trying to trade really short term and all the little lumps and bumps at the index level is really just a bit of a lottery at the moment. So I'd really recommend that you probably don't try that. It seems to me that governments and central banks are absolutely hell-bent on preventing a normal market correction, and they'll do whatever they need to do to hold stock markets up. And that's probably associated with the fact we've got the US elections coming up at the end of this year. And so I think it's starting to look increasingly like we're not going to get a significant correction. We may see some corrections, in fact we almost certainly will, but I think you'll just see forces move into the market and continue to support them. I'm focusing on stocks which are moving up and down in our market purely on local reasons. So I'm talking profit downgrades, and I'm talking about reversals from extreme levels of oversold and overbought. So that really they're moving independent of what's happening overseas, because those market movements are just crazy. In terms of current exposure, my recommendation would be keep cash up your sleeve, because the sell-offs tend to come when least expected. When people get complacent, that's when we tend to see some sharp moves to the downside in stock markets. So I'd keep some cash up your sleeve. I'd keep a close eye on the euro US dollar. If it gets up around the 126 level, that would be an area where you'd be wanting to look maybe for stocks to turn back down again. So that's it for this week. Cheers.